Hi, everyone. Welcome back to the G360 Podcast. This is the second episode of our generational investment series. Today, I'm joined by Phil Huber. Phil is the Chief Portfolio Strategist at Cliffwater. Is that correct?
No,
Head of Portfolio Strategies?
Head of Portfolio Solutions.
Head of Portfolio Solutions at Cliffwater. You're also an author of this book, The Allocator's Edge. Phil, it is a pleasure to have you here. Thanks for taking some time.
Yeah, it's a pleasure to be here. Thank you for having me.
So I want to start with the basics. Who is Cliffwater? I know a lot about their consulting history and their roots, but talk to me a little bit about who Cliffwater is and where they stand in the market.
Sure. So we were founded a little over 20 years ago by a gentleman named Stephen Nesbitt. So prior to founding Cliffwater, Steve led institutional consulting for Wilshire Associates, which is a very large consulting firm that helps, various types of institutional investors, be it pensions, endowments, foundations, what have you, build portfolios. Where Steve wanted to create something different was really a focus on alternative investments. And so that was kind of the genesis of Cliffwater, which is focused on that same audience of institutional investors, but really focusing across private equity, private debt, real assets, hedge funds, and working with those institutions to help them with due diligence, manager selection, asset allocation across that spectrum of private markets and other alternative asset classes. So that was largely the business for the first, call it 15 years or so of our history. Today, there's that business is still part of our firm. It's about 80 billion of assets under advisement. What's changed in the past, call it 5 or 6 years, is that we've now also become an asset manager ourselves, focused on a different audience for that part of our business, which is the private wealth channel. So in 2019, we launched our first strategy, and today that's grown to 3 strategies that we offer investors across private debt and private equity, all under the interval fund structure or wrapper. And so today that part of our business is about 37 billion of assets under management. And we're excited about how it's grown.
Yeah, we'll talk a little bit more about the interval structure a little bit later. Tell me a little bit about your journey, because you didn't start at Cliffwater. You were sort of on the RIA side, more on the client-facing side as a CIO. Tell me a little bit about that story at Savant.
Yeah, so I kind of sat in more near seat for the vast majority of my career. I grew up with a father who was and still is a financial advisor. He started his own firm in the late 80s. I joined shortly after graduating college in 2008. Wonderful year to get in.
Yeah.
And so that was where I spent the bulk of my career, was at our firm, which was Huber Financial Advisors. Over time there, kind of gravitated more to the investment side of the business versus the planning side. Ultimately became CIO of Huber Financial, and then fast forward to beginning of 2020. Also an interesting time. a lot of these big career milestones just happen to take place during recessions or pandemics or what have you. But we decided to sell our business and merge into Savant Wealth Management, which has today become a pretty national RIA, about 30 billion of AUM, offices in a number of different states. And so my dad is still there, actually, as an advisor. I left about a year and a half ago, beginning of 2024, to join Cliffwater. The reason, being I had, over many years, kind of going back as long as I can remember in my career, just became really fascinated by the world of alternative investments. When I think about my, philosophy around public markets and the way we invested client money, it was more of a, call it long-term strategic asset allocation, more sort of buy, hold, and rebalance, focus on, broad diversification, low costs, et cetera. When you have that type of philosophy, not a lot sort of changes day to day. And so what it does is it affords you the time to think about, okay, if I've got this sort of core belief in market efficiency, and that just broad strategic asset allocation is the best way to invest. You focus your time on, okay, are there other ways to improve strategic asset allocation through the utilization of non-traditional investments or things like private markets. And so just started to really spend a lot of time learning about that world and how it might intersect with the types of clients that we served. And so when you think about, investing historically in things like private equity or private debt, often that came with, exorbitant minimums and really difficult to access managers and things like that. So though that type of investing up until recently was a bit off limits for the types of clients that we worked with, the majority of our clients were kind of $1 to $10 million of investable AUM. And so things like mutual funds or ETFs were kind of more their speed, more what they were accustomed to. So naturally we started on the liquid alternative side of things with certain strategies that we thought could be good diversifiers. And then as the interval fund structure became more prominent, and I would say just evergreen fund structures more broadly, that really opened the door to things like private equity and private debt to be included as part of an overall portfolio. And so just became really enamored with this world and kind of dove headfirst into it. Eventually published the book that you showed a bit earlier called The Allocator's Edge, which is really written to financial advisors as sort of a how-to guide for alternatives. So I kind of pivoted my career already towards this part of the market. And so it was just sort of natural that at some point I would, I really enjoyed my role as CIO. It was everything I kind of hoped it would be and dreamed for, but it just felt like it was time for something different and more kind of focused in this world. And fortunately, I had an existing relationship with Cliffwater as an investor and allocator to their funds. Knew the platform well, knew the people well. And so, the rest, as they say, is history. But we sort of created this role of head of portfolio solutions and ultimately joined the firm to help with things, a variety of things, but help create and publish research for our clients and investors, help out with business development and product strategy, things of that nature. So it's been really enjoyable thus far.
Great. Yeah. I mean, it's super interesting. As our clients will know, our investment philosophy here at GCA is simplification is the ultimate form of sophistication. So we try to keep many things in the portfolio simple and easy to understand because we are long-term believers of American exceptionalism, and we believe that the market is going to perform well over long time horizons and long periods. What we do when we build our portfolios is we use a core and explore strategy, where our core is just long-term beta, where we try and strip out the cost, strip out the complexities, and own the market. And on the explore side of things is where your firm tends to come in, where we add alternatives, whether that's, direct lending, corporate lending, private credit, private equity, maybe some hedge fund or some beta neutral, really to help expand into uncorrelated asset classes to diversify further. I think the question or the concern about that is we talk about alternatives as a broad term, right? But when we think about alternative investments, what exactly are we referring to? And why is it, more prevalent in today's market than it was, I would say, before the 2022 fixed income market had a little bit of a hiccup?
Yeah, I would say inertia is a very powerful force. For many years, many decades, in fact, investors got accustomed to the role that traditional bonds or fixed income played in a portfolio as a sort of offset to equity risk, and that worked really well for a period of time, where you could just be reliant upon, okay, equities are down significantly, my bonds are acting as a ballast and providing me income and potentially even positive returns during deep bear markets or recessions. That in a very non-inflationary environment, that relationship held up pretty well. The challenge was as rates kind of continued to shrink to eventually rock bottom levels. We didn't have the short end effectively at zero, and even at one point in 2020, the 10-year was, I think, it like bottomed at 1.5% or something crazy like that. And so what's interesting about bonds relative to stocks, stocks move all over the place, and maybe valuations can be predictive over a very long time horizon. But they're much more volatile. Bonds, the math is a little bit more straightforward, not necessarily on a 1-year basis, but as you look out 5, 7, maybe 10 years, your starting yield is a pretty good approximation and explains the vast majority of what your expected return is. And so when you have a 10-year, yielding 1.5%, that kind of tells you roughly what to expect over the next 10 or so years. Not a very attractive proposition and that's before you account for fees and taxes and all those other things. And so just the go forward value proposition of fixed income was looking unattractive. But advisors and individual investors, institutional investors as well, tend to anchor to what's worked well in the past. And so the challenge that created was not just generating returns, but the sort of spark that lit the match, if you will, of inflation rearing its ugly head in 2022, kind of demonstrated to investors that maybe hadn't lived through the 70s just what high and rising inflation can do to a traditional 60-40 portfolio. And so that we experienced double-digit declines in both asset classes. So I think it really brought to the forefront for a lot of asset allocators, okay, there's maybe a third leg of the stool, or maybe more than 3 legs of the stool. In other words, there's more ways to diversify a portfolio beyond traditional stocks and bonds. And so I think that's why there's increasing attention being paid to things like private markets for the potential they can offer from a growth and yield standpoint for investors just seeking more stability in their outcomes, if you will.
Yeah. And so when we think about sort of this new age of portfolios where fixed income is what we would call positively correlated to the equity markets, especially it really wasn't just 2022. It's continued throughout the last few years. Why should investors think about adding something like corporate lending to their portfolio? Is it because it does add that diversification factor? It's another way to have slightly better return. We like to look at it as total return, not just an income play, right? But why should an investor, specifically on the corporate lending, why should they think about adding that as another balance to the portfolio as opposed to just holding traditional bonds?
Yeah, corporate direct lending is a really interesting asset class. It's something I think we became quite known for in the market from a brand standpoint. Frankly, the firm as well before I joined, but just very early to the asset class. Steve had great foresight into kind of seeing where the trend was headed with this market, dating back as kind of early as the early 2010s, and really viewing direct lending becoming the next big institutional asset class. When you look at the prevailing trends of the growth of private equity, which the vast majority of private debt financing is going towards private equity-backed companies, and also the post-GFC retrenchment by banks that historically were the main source of funding for these types of loans. Ultimately regulation kind of handicapped their ability to continue to play the same role in that market. And so really you saw a number of asset managers sort of step in to fill that void. So we spent a lot of time getting to know the players in that market. This kind of leans back to our consulting background, before we had any strategies that we managed ourselves, which was, hey, there's, call it 300 plus direct lenders out there servicing this middle market, which we'll call, middle market. These are companies with anywhere from, say $10 to $100 million of annual EBITDA or annual earnings. So it's a pretty large market. There's thousands of borrowers and companies that fit this profile. They continue to need funding and financing, and ultimately banks are either not willing or not able to play that role any longer. And so it really created this strong tailwind for the asset class to mature and grow to the degree that it has. Today, it's about $1.7 trillion in size, so it's gotten quite large. It's very broad in terms of industries and borrowers that kind of tap into this lending source. The way the loans are structured are senior secured first lien loans, so top of the capital structure in the event of a default or bankruptcy, first to be paid back. The loans are floating rate. This is an important feature in the sense that really the risk you're bearing in this asset class is pure credit risk. You're not taking on interest rate risk like you would in fixed rate, kind of core fixed income. What we find it more comparable to is less so your Bloomberg aggregate bond type exposures, which is investment grade, kind of government, corporate, that sort of thing. Where it's more comparable to in public markets would be things like high yield bonds or what we call BSL or broadly syndicated loans that trade in the public markets that are not investment grade. So what we found historically, and back to kind of being early to this asset class, well before we had any sort of funds that we managed, we created an index for the category called the Cliffwater Direct Lending Index, or CDLI for short. And so the intention there was, Steve's view was just, if this is going to become a big institutional asset class, it needs a benchmark that investors and allocators can sort of anchor to and formulate capital market assumptions and, benchmark manager returns, all those sorts of things. And so he created that index, which, began in 2015, has data going back to 2004, and has really become sort of the gold standard in many ways for indexing this category.
Yeah, absolutely. I mean, the alternative investment, ecosystem at large tends to, I think, over focus on standard deviation, and it's hard to get a good benchmark where, you're adding a 60-40 benchmark that includes the ag, right? But that might not be the best way to compare, some of these strategies that you guys run. And I think when you break down the 2022 timeframe, I think, you touched on it, how being floating rate is a specific feature that's quite impactful for investors here, because where you have duration risk, where in 2022 we saw rates rise, almost the fastest in history and during the shortest period of time. How does that affect how investors are receiving yields from corporate lending with floating rate as opposed to regular traditional bonds?
The way to think about that is that the two main drivers of the investors' all-in yield are going to be a floating rate floor, so something like SOFR, SOFR, that will fluctuate alongside, Fed funds, if you will, and then that's paired with a fixed credit spread. And so what you'll find is that those are going to be the two dynamics that ultimately drive returns over time, like where are short-term interest rates and what do credit spreads look like. What those two in combination have produced historically, and this is looking at our index, which is going back now, 20 or so years, is about 9.5% returns. And in some cases, like, you'll have really low short rates, but that's, what we find is the dynamic between the two components tends to be inverse, meaning credit spreads tend to be higher when short rates are lower, and vice versa. But generally, all in, it's been fairly consistent, that kind of returns huddling around that long-term average of about 9.5%. That 9.5%, by comparison to something like high yield bonds or the broadly syndicated loan market, has been historically about a 300 to 400 basis point premium to those markets for very similar credit risk. That's something we've been able to analyze over time, which is, what have historical defaults and credit losses looked like in direct lending versus those other two categories. And interestingly enough, what you find is not exactly the same, but close enough, where it's kind of roughly 2% default rates on average over time, not every year. And then, your credit losses are a function of your default rate and then your recovery rate. How much are you recovering in the event of default? And that historically for direct lending has tended to be about 50%. And so what that's meant long term is about 1% annualized credit losses, which is pretty on par with what we've seen in high yield bonds. High yield bonds have been a bit higher, maybe 1.5% or so, and then broadly syndicated loans roughly 1%. So to our view would be that historical return premium or yield premium for direct lending is compensation to investors for bearing illiquidity risk. Whereas these loans are held to maturity, they're originated by an asset manager and meant to be held, not traded. Whereas the broadly syndicated loans are, as the name implies, syndicated out to many different investors. The banks don't, the banks are in the moving business, not the storage business. So they're originating these loans to sell, not to hold. And so we think that additional premium is compensation for investors bearing that illiquidity. On the flip side, somebody's paying that additional interest. So the question often comes up, why would somebody pay, that much additional?
Right. If you're a firm out there that's looking for that capital, why would they accept that higher rate?
Exactly. So two reasons, really. One, there's certain companies that banks just won't lend to, maybe based on size or earnings profile, whatever the case might be. But even companies that otherwise could tap into the bank market are opting to go the direct lending route for reasons of, okay, if the majority of this market is companies backed by private equity sponsors, these PE sponsors highly value the speed and certainty of execution that direct lenders can provide, as well as the flexibility and privacy that they offer as well. So in other words, that's the explanation for that yield premium, because it offers a great deal of value to these PE sponsors when they're purchasing a business or evaluating an M&A transaction or some other purpose for that financing.
Great. So we talked a lot about the direct lending space, but in the private equity market, it can kind of feel like a bit of a black box where it's this super broad term and there's lots of different sub segments of it. But can you break down for our listeners, just at a high level, how private equity differentiates from public equity? And again, how they should think about private equity falling into their portfolio at large and where it sort of adds a ballast or what exposure it might get them access to that they might not currently be able to get from the public sector.
Absolutely. So when you look at private equity in comparison to public stocks, we can really look across 4 different dimensions to look to where the key differences are. The first being the ownership itself. In private equity, you have a very small group of and hence the name private owners, relative to public stocks where you have thousands or potentially millions of individual shareholders. There's time horizon. So one of the perceived benefits of private equity is that it involves more long-term strategic planning, and it's not subject to the whims of quarterly earnings focus that can maybe take public stock company managers off the long-term ball if they're focused so much on shareholder value on a quarter-by-quarter basis. Third being investor involvement. PE sponsors tend to take a more active role as managers or owners versus investors in public companies taking a more passive role in their ownership of stocks. And then lastly would be market efficiency. Despite all the growth of private equity, it's still a much more highly inefficient market than what you'll find in public stocks. And there's more of an asymmetric kind of private information component there that frankly can't exist in public markets because of fair disclosure laws. So those are the 4 main differences, I would say. In terms of the opportunity set in private equity, it really does sit on a spectrum of different risk return objectives as well as different stages of the corporate life cycle. So on one end, you'll have venture capital, which is companies that are maybe earlier in their inception, not yet profitable. Many of the largest companies today in the S&P 500 began their life as a venture-backed company. Facebook or Spotify. I mean, countless examples of mega cap, technology companies that at one point were just an idea that someone had that they had to go out and raise capital for, and didn't really have any revenue or profits to show, but really kind of getting that bet on a big idea. Growth equity sort of sits in the middle. These are kind of more proven business models and maybe cash flow positive companies, but they do have a need for expansion and growth capital. And typically these are structured as minority transactions. And then lastly, you have what people think about most when they hear private equity, which would be buyout transactions. These are mature companies that have some opportunity to increase earnings either through increased revenue or improved margins or something along those lines. And these tend to be majority transactions where the purchaser is purchasing at least half of the underlying company. The other thing, so in addition to the types of companies you can invest in private equity, what's evolved quite a bit over the years is the different ways that you can invest in private equity. Historically, it's been through what they call primary funds, where you're committing capital to a private equity manager. You're sort of investing in a blind pool. The manager calls your capital over a multi-year period, and you're sort of betting on their capabilities and track record and expertise to go out and find the right investments to make, and then earn your capital over the next decade or so. But there's a bit of a gamble there, and you also have the responsibility as an investor of, okay, I'm committing $1 million. We'll say it might not be called for 3 to 5 years. I've got to figure out what to do with that $1 million in the meantime, which adds an additional burden on the investor to which can potentially be a drag on returns if they're not optimizing that decision.
Right. Yeah, I kind of want to dive into that a little bit more, because I think what Cliffwater does that's a little bit differentiated is the structure that they actually offer the funds. You're talking about those primary offerings. I think a lot of our clients, specifically in the private wealth world, that the brokers or wires are likely very familiar with those if they're implementing alternatives. And so you have a lot of things that could go against you, like if you have the proper vintage year, right? Or, how long it takes to deploy the capital, or what does that J curve actually look like? And, right now we're seeing companies stay private for longer, right? So that J curve tends to be a little bit different. Talk to me about how Cliffwater has implemented this interval fund and what are the benefits or the advantages that it offers to investors over doing a traditional capital call structure.
Yeah, so I would say to talk about the interval fund wrapper, and this is really all we do in our asset management is interval funds. So it's a structure that we know and like quite well, but there's a lot of nuance to it. And given one of the key features, which I'll get to in a minute, you have to really think about implementation because you can't necessarily do it the traditional way inside of a vehicle like ours that offers semi-liquidity. So, but before we get to the liquidity piece, the way to think about something like an interval fund relative to traditional private funds, or even relative to things like mutual funds and ETFs, there's a variety of different variables to look at. First will be access. Most traditional private equity funds or private debt funds or private markets in general require investors to be what's called a qualified purchaser, meaning they have to have at least $5 million of investable assets just to be even eligible to participate in the fund. What's different about interval funds is often they are available to investors that meet the accredited investor definition, which is a lower hurdle. Usually it's income-based or net worth-based, but much more investors satisfy that requirement than do qualified purchaser. Right. Or there's even interval funds that have no eligibility requirements, meaning any investor can come in. So it does broaden the accessibility to a wider number of investor types. Diversification, you get more of it inside of these structures relative to if you are committing to single manager, private funds. That would take a lot of different line items to build the appropriate level of diversification that we think you need to manage risk in a private market allocation. And we also think that consultant type firms like ours, sort of consultant turned asset manager firms like Cliffwater and some of our peers, are uniquely suited to offer that type of diversification, given that we are not in the business of originating loans ourselves or going out and purchasing companies ourselves from a private equity standpoint. What we aim to do is partner with what we view to be top tier specialist managers in their respective categories and really leverage the relationships that we've spent 2 decades now building in the private market world and bring multi-manager solutions to individual investors through their financial advisors. And so it's really this idea of having almost a one-stop solution for direct lending or private equity, as opposed to going bottoms up and doing it the more complex route, which requires a much more operationally intensive, as well as a large amount of capital to actually do that at scale. So and it also gives us greater ability to deploy capital. When you have this sort of open architecture structure, it really enhances the funnel of opportunities that you can evaluate. Whereas if you're just a single manager, you're really beholden to the origination efforts of your own lending desk or private equity desk. The other advantage that we think interval funds offer is lower minimums. So for investors that do qualify, typically the bite sizes are quite small. There's really no individual investor minimums. There's operational ease that comes with it. Interval funds trade with ticker symbols. They publish a daily net asset value, much like a mutual fund or an ETF would. They offer 1099 tax reporting for investors as opposed to the more onerous K1 statements. And then the last piece we'll hit on, which is the most important, I think, is liquidity. So if you think of the private fund experience, a drawdown fund, it's going to take you at least a decade to have all of your capital returned to you, and that liquidity is controlled by the GP, not by you as the investor. Contrast that with a mutual fund or an ETF, investors can come into and redeem out of daily. So interval funds sort of sit in the middle in the sense that investors can come in daily, but they can't get out daily. And that's a function of you don't want to have a mismatch of the liquidity of the vehicle and the underlying assets in there. At the end of the day, they're still private assets. They are illiquid. And so you need to have a guardrail or a mechanism in place to provide liquidity, but also limit it as well. And so that's what interval funds do, is that they either on a quarterly basis or a semi-annual basis offer to repurchase up to 5% of the fund's value to investors. And so long as under 5% of investors request their redemptions in that period, they get 100 cents on the dollar back. In the event that there are elevated redemptions above that 5% number, there is the possibility of investors being prorated, meaning they may not get their full 100 cents on the dollar redeemed if they're looking for it. So it's an important consideration, in that it's a nice to have feature for investors that, maybe have variable liquidity needs and want some confidence that they'll at least have partial liquidity on an ongoing or periodic basis, but they don't have the guarantee of full liquidity at all times. And so it does sit at that sort of middle ground of the daily liquidity offered by a mutual fund and the more stringent illiquidity that a private fund might have.
Right. So it does offer quite in what we like to talk about is a simpler solution for access, right? You talked about that 1099 reporting. We often see some of the private equity deals where you're getting K1s way beyond the fact in multiple different states, and that's just more complexity, more filing, capital calls, right? You don't have to worry about any of those things with this structure. The other thing I want to talk about is how the NAV is actually updated and marked to market on a daily basis. Can you talk a little bit about the beta adjustments and how Cliffwater adjusts those NAVs? Whereas historically, the alternative, there's been a lot of debate and opinions, right, on how are these portfolio managers properly marking their asset values. So talk to me a little bit about how Cliffwater does do those markings and what they do for beta adjustments to make sure that you're not getting that shock factor if there is large swings in the markets at large.
Yeah, absolutely. So we think it's critically important for investors in our funds, or any interval fund for that matter, that has a daily net asset value that it publishes, that investors can come into the fund or redeem out of the fund with confidence in the price that they are receiving. But ultimately, the assets that we own, those tend to get valued on either a quarterly or in some cases monthly basis. And so you do have a gap there. And so we think it's important to have some mechanism in place to account for that gap in valuations. Well, ultimately, what we don't want is for the inherent, there's an inherent lag in private markets relative to public, but there's a correlation between what's happening in public credit to private credit, and similarly in public equities to private equity. It's not a one-for-one relationship, but there is some sensitivity there that we need to be mindful of. And so I think one thing that we've innovated with across our platform, which has been largely adopted by the industry now, is this idea of a daily beta adjustment, meaning we examine the historical sensitivity of the private market asset class to its public market equivalent, and find, okay, is there a beta sensitivity to that? And if so, that's statistically significant, then we want to make sure that we apply that, so that our daily marks are not ignoring what's happening in public markets and can track along to a degree as we wait for eventually the call it quarterly updates to come in from our GPs that we work with. It sort of bridges the gap, and then eventually you have a true up to that new update. So that's really the idea there, is to just have investors have confidence in price and not bury your head in the sand as to what's happening in the world around you. It doesn't mean there's a one-for-one relationship to those markets, but again, we want to be mindful that investors have the right experience in that regard.
Right. Yeah, I think that's a key differentiator for you guys in the space. When we think about our investors, is there anything that they should be aware of or concerned about when they're thinking about making their first couple investments in the alternative space? I think, if you look at the data, you could probably drive a truck through the differentiators or the differences between the top managers and the bottom managers. Is there anything that investors should be worried about or be aware of, or any misconceptions in this space before they take their dive in?
I think the most common thing, and so maybe, I'll put my old hat back on for what I used to be on your side of the business, which is you would sometimes, where you would see the biggest mistakes being made in private markets for investors that were newer and maybe not as well informed as they should be, was this notion of adverse selection and over concentration would be the two biggest risks or blind spots that individuals might not be aware of. On the adverse selection side, again, you just mentioned it. It's that dispersion of returns between your best performing private equity funds, we'll say, and worst performing is very large, significantly wider than that same gap that you would find in, let's say, large cap U.S. equity managers in public markets. And so obviously everybody wants the best managers, and no one thinks they're investing in the bottom quartile, but ultimately somebody has to. That's just the way it works. I think what's challenging in private equity or in private markets in general, it's a very relationship driven business. And I would worry at times if I were an individual and I begin to get reached out to or emailed by private equity funds wanting me to come and invest in them directly. My question to myself would be how many people and who said no before you made your way down your list all the way to lucky old me. And so I think there is a benefit to sort of outsourcing that manager selection decision to a partner, that you can trust and that has experience in that endeavor, and demonstrated capabilities there. And then similarly, over concentration, you'll often find investors that say, oh, well, I put X dollars in a startup, or I invested in this one PE fund from a single manager in a single vintage, and that's my private equity allocation. It's like, well, you've made a very concentrated bet on a particular vintage or strategy or manager, or in some cases, a single company. That does not necessarily serve as a diversified private equity allocation. And so I think maybe just lack of understanding of the types of bets you're making. What's different about private markets versus public is public markets, every one of us has the same opportunity set. We can all go out and purchase the same stocks. Private equity is really what's presented to you. And unfortunately for most individuals, what's presented to them is not necessarily always the best. And just given our background, we've done a lot of work over the years with institutions on how to properly build a private market program. And that involves, diversification across styles, across managers, across vintages, to really cut out some of the tail risk and try to improve your odds of capturing that historical return premium, which we think can be material. We've actually done a study now, going back 20 years, where we look at, for private equity, public pension return data, because it's all publicly available information, and we can actually see the returns generated net of fees by the private equity programs of these 50 plus pension plans. And it's interesting because what we found is actually a pretty consistent return premium to public markets. And so that study has 23 years of return history now. And we look at rolling 5-year returns. And essentially what we found was, over on a rolling 5-year basis, returns for private equity at these pensions was positive 100% of the time. It beat public equities about 90% of the time. The average outperformance of those periods was about 5% per annum. And the kind of median percentile performance was a little over 11%. And so that's why investors are wanting access to this market, because it could be substantial if it's done correctly. And so if when you're sacrificing liquidity, you're paying higher fees, you're bearing greater complexity. Like, why would anybody do this? It's because they want to elevate the yield and growth profile of their portfolios, and they have conviction that private markets are a path to pursue that.
Right. Absolutely. And I think that the takeaway for our listeners here should be that if they're looking to diversify their portfolios beyond the traditional 60-40 approach, and really to gain access to some more uncorrelated asset classes like direct lending and like private equity, they can do so in ways through something like Cliffwater's interval fund structure. And as a reminder, it's just super important to peel back the curtain and to understand the products and strategies that are actually occurring here, what the leverage risk is, what are the manager risk here, how important is manager selection, and making sure that you're talking with your advisor, making sure that if you have that longer term time horizon and you're willing to give up that liquidity, that adding products and strategies like Cliffwater strategies and funds can significantly, improve that risk return profile if they are right and the strategies are fit for them. So for listeners that do want to learn more about Cliffwater strategies, what's the best way to get started or to learn more?
Pretty easy. I would say just cliffwaterfunds.com is where you can go find some information about our suite of solutions. And then, of course, like any good company, we've got a LinkedIn presence as well. And so if you follow us on LinkedIn, we'll post research and things like that can hopefully offer some education around the types of things that we're investing in. So the one pagers
are great. I love what you guys are posting on LinkedIn. I know there was one on PIC recently that was there's a lot of opinions out there on that as well, and so it's just good to stay up to date. For those that are interested in learning more about your book, Phil, where can they gain access to this?
Oh, sure. Yeah. I mean, thanks for the plug, of course. I would say all the major places you would find books these days, Amazon, Barnes and Noble, what have you, can find it online. And it was interestingly, I wrote that book before I joined Cliffwater. It came out like a little over 3 years ago. So this was kind of back when I was wearing my CIO hat, and really kind of the whole intention of writing it was to help educate financial advisors on this kind of broad opportunity set and alternatives, and it being a very loaded word. And so I think just to help folks better understand the underlying components that comprise that landscape, and to hopefully make some better decisions for their clients that incorporate that knowledge.
Great. Well, I certainly, I read through it. It's an exceptional book, especially for advisors, just to gain a better understanding of the alternative landscape at large and how diversification really can build benefits into your clients' portfolios. If you're a listener today and you're interested in learning more about how you can add alternatives into your portfolio and you want to speak with an advisor, the best way to do so is by visiting our website, generationcapitaladvisors.com, to schedule a discovery meeting. And Sam and myself will be happy to review your portfolio, to educate you on these strategies and see if it does fit into your portfolio and fit into your risk appetite and your long-term financial plan. Phil, it was a pleasure having you on the G360 podcast. Thanks for taking some time to share a little bit about what Cliffwater and yourself are doing in the space. We appreciate having you guys as a partner and a core staple of our alternative offering. And thanks so much for your time.
My pleasure. Thanks for having me.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.